Okay, well, let's get started. Hi, everybody. My name is Peter Hans. I'm a managing director here at Arca. I'm also joined by our founder and co-founder and CEO, Rain Steinberg. So thank you, everyone, and welcome. This is a webinar introducing our first passive product, the Arca Accredited Investor Bitcoin Trust. So we'll go over a little bit, very brief introduction to Arca. Then I'm going to kick it over to Rain so he can introduce himself, talk a little bit about just kind of overall market dynamics, our view of Bitcoin, and kind of where that fits in. We're not going to belabor that too much because most of you probably already have an opinion on it, and there's about 2 billion other resources you can go to get more macro information on Bitcoin. And then we'll spend a lot of time just kind of overall on um, this structure, why this product is differentiated versus what else is on the market, as well as answer any questions that we received both beforehand as well as that come in live through the webinar. So first, quickly, as an introduction to Arca. Arca is a asset management firm solely focused on the blockchain technology and corresponding digital asset space. The founders of Arca are Rain, CIO Jeff Dorman, who I've personally been working with for nearly 20 years, and Chief Legal Officer Phil Liu. We all come from traditional asset management and traditional financial backgrounds. The four of us have spent all 20 plus years in the traditional asset classes. And our real mission is to fully institutionalize this very nascent and really at this point in the game, esoteric asset class as it continues to grow and put a true institutional infrastructure behind it that really prioritizes our investors as our partners so that we can grow a kind of multi-product offering that creates very symbiotic relationships with our client base. Because we are of the view that we are in the extreme early stages of what will be a massive secular shift as blockchain kind of permeates all aspects of our economy. And today we're going to talk about the one that started it all in Bitcoin. So if we look at Arca as an organization and really a asset management firm, Arca is the parent company. Most of you on this call are probably familiar with our hedge fund solution and real alpha generating focused product, the kind of flagship of which is the Arca Digital Asset Fund, which launched in August of 2018, and can certainly talk offline about that product and performance. This is our first entree into passive vehicles, which I think certainly has its place in this asset class, even though it is very inefficient and as I said before, nascent, and there are a lot of opportunities for alpha generation that probably do not exist, certainly do not exist to the extent in more traditional asset classes, but there are also opportunities for single asset, especially passive vehicles. And then we have a side of the business called Arca Labs, which is really our innovation and R&D arm. And we're doing some incredibly interesting things there as well. Many of you might have seen the Arcoin announcement last summer, but essentially we have a team that's been working very closely with the SEC, with regulators, and we have the first blockchain transferred fund, which is a SEC registered 40 Act mutual fund that invests in short duration treasuries, just like any other short duration treasury mutual fund, except instead of going to Schwab or Fidelity and buying the mutual fund and using the traditional custodian transfer agent, we've issued a token called Arcoin. So it's an asset-backed token where your ownership of the token is directly translate to your ownership of the underlying mutual fund, and the interest from those treasuries is a pass-through to the token holder. So incredibly early in kind of the life cycle of that product structure, but we have plans as an organization to tokenize many different financial instruments and opportunities. And me personally, being in this seat, extremely excited for the company, its growth potential, and really the consistent innovation of this asset class and what we have to offer our partners and clients. So now I'm going to introduce our CEO and co-founder, Rain Steinberg. Rain is, it has an incredible vision. I think as it comes to this, he co-founded Wisdom Tree in the early 2000s, and is just, you know, an all-around great mind in this space, and has a great vision for the company. So I'm going to kick it over to Rain as he talks about the Bitcoin and really what we're trying to accomplish here.
Thanks a lot, Peter. Yeah, I think the most important thing there, just on my bio and just the way we look at the space, you know, I co-founded Wisdom Tree in the early 2000s, and that was 20 years after ETFs really were created. And it was still, when I look back at some of the data, it was a $40 billion asset class around then when we started Wisdom Tree, and now, you know, multi-trillion. We think we're at an earlier point here in crypto when we think about it. And when you think about something as simple as an ETF, you know, intraday liquidity, you know, better tax efficiency, and how long that took to permeate out through, you know, regulated financial products, you can see how difficult it is for something like digital assets that's so disruptive to the financial ecosystem that even at the current time, this is what people are really interested in. Where are we kind of in this cycle? And as Peter alluded to, we're not going to tell you what level Bitcoin should be in your portfolio. We think it has, you know, differing properties for differing views, and that's one of the interesting things about it. You know, it's really a macro play, and where people see it fitting is very personal. What is true about all of our clients is they're sophisticated investors, that they are looking for the best way to express that view, and that's what we're trying to do here at Arca. So that's our overall view on this, on, you know, just structure and how to address it. But what we're really trying to hit here is really still how early it is. So I was refreshing some of my data, and you really have to move very quickly to keep it up to date. Just looking back at the beginning of 2020, when we're talking about you know, the start of the pandemic, when Bitcoin was sub 10,000, and I think a very seminal moment was the Paul Tudor Jones letter that you know, highlighted it in a way that institutions could think about it. And that was when Bitcoin was you know, in the tens of billions of dollars in size. So, you know, we're over $1 trillion in size, but when you think about it in relation to other financial assets, you know, the Bitcoin and crypto dots are in there in the middle of this slide, and you have these radiating out other giant blobs, which this is potentially disruptive of. So when we're talking about gold, you know, when we're talking about the store of value thesis, you're still 1/10 of above ground gold, which is at about $10 trillion when you're talking about Bitcoin at $1 trillion. So could you have a 10x return on Bitcoin if it were to displace gold in the narrative of store of value? Possibly. When you're talking about money, you know, when we're just talking about coins, you know, notes in circulation, you know, the equivalent of M1, you're talking about in the neighborhood of 6 trillion globally. When you're contextualizing it in the realm of stocks, you're over 100 trillion in global stock assets. And then when people are talking about, you know, the fixed supply, this replacement for money, this inability to inflate it, which is one of the problems with our central governments, you have over 275 trillion dollars in global debt. And then when you talk about like the actual size of like the shadow financial system, it's impossible to even measure because a lot of these things are off the books. It goes anywhere from 800 trillion to 1.4 quadrillion on the high end. I mean, these are numbers that are so big, it's really hard to even contextualize them and like as we understand them. But Bitcoin and the crypto market in general is many, many, many fractions less than that. So incredibly early still. You could have had this slide 1 year previous to any point in Bitcoin, and it would generally look like this, except for some of the drawdowns. It's still incredibly early. The other thing that we just wanted to highlight here is its anti-fragile nature. This is this idea that when we're talking about systemic risk, when we're talking about you know, what's something like a disruption, and we're still working through, you know, the ramifications of a pandemic, you know, this is one of those assets that actually gains strength and you know, traction, the more unstable the traditional world is. The narrative of Bitcoin is gaining strength by what's going on in our central governments. When I was updating M1 for this slide, the last time I put it in a slide, even though I think about it all the time, was $3.7 trillion. And then when I looked at it, it was 18 trillion. And the graph actually looks insane if you really thought about it, at the speed at which money is being created by the authorities that have the power to create it. And it's very hard to reverse that. Once you get that going, it's generally one of those things that gains speed, and we're starting to see that. So it's incredibly hard to reverse. Next slide, please. Yes, this is what I was alluding to, which I thought was an incredibly important event. Since early 2000, we've had a lot of bellwethers and very important people come into the Bitcoin space and recognize its value and recognize digital assets, and it usually starts with Bitcoin. But I think one of the most interesting ones that's still a very important rubric to look at it through is the way Paul Tudor Jones looked at it, which was, let's just take the great monetary inflation thesis and think about what happens in an incredibly inflationary environment. And that's what we're often talking about when we have concerns about money and purchasing power and things like that. And let's look at all of the various ways that people think about hedging it or looking at that risk. And he ranked them. And this was before, everybody thought that you should be holding Bitcoin in their treasuries and all of these things. And he came up with that no matter where you ranked the properties of Bitcoin, it was still just incredibly cheap compared to other assets in that. So let's say, just as a random ranking, here they have 43, that Bitcoin scored a 43 in its properties as an inflation hedge versus financial assets, which were a 71. Even if you got those scores completely wrong, the size and price of Bitcoin was so low that the risk reward on it made so much more sense than almost any other asset when you're talking about that. That's very important. The other important thing about the Paul Tudor Jones letter was the co-author. Lorenzo Giorgione, who's the head of research at Tudor, his previous job was the head of strategy at the IMF. Now, the interesting thing about this, these are the anti-Bitcoin people. These are not the general people that were evangelizing the properties of Bitcoin. You can almost imagine these as the people that are anti-Bitcoin. The IMF, central monetary authorities, these are not the people that are interested in the expansion of a Bitcoin narrative. So those two people, I think, really kicked off the institutional view that it's okay to look at this asset as no longer magic internet money, and to really think of it as an inflation hedge, possibly the most inappropriately priced inflation hedge. And that was really a signal to a lot of institutions and sophisticated investors that it's okay to investigate this asset seriously. Next slide, please. I mean, this really speaks for itself, but people just forget what, even when we're talking about normal calculated CPI, the degradation of purchasing power in the dollar. And when we think about the dollar, history of money, the turnovers of reserve currencies, the dollar is the reserve currency of the world. The dollarization of things like petroleum and having to do business in it has made it a sticky and necessary asset. We are at about the 80 or 90 year, depending on how you look at it, or the shift over from the Great British Pound to now in the life cycle, and that's generally where reserve currencies shift. Now, that's interesting because in the past, there's never been a decentralized reserve currency. So this is the first time where we've been at a global scale where there has been an alternative to something controlled by a central government to fill that niche, and that's Bitcoin. So, I mean, it's just a very powerful idea to see how much, even in under normal calculated inflation, the power of your dollar has deteriorated, and that's in a reserve currency. This is not, a emerging market, currency. This is one that people have to hold and use to tell you what's going on generally. Next slide, please. So that was just to highlight the properties of Bitcoin and just kind of the way we think about it, and me personally, how I think about it. But it's a very personal decision, what weight you want it in your portfolio. And that's how we view it. We create actively managed products for things that we think we have alpha around. There's tremendous asymmetries of information in this space, and that's where we deploy, our tremendous research and active practice led by Jeff Dorman. But he'll often say that the one thing in our digital asset fund, which does hold Bitcoin, but not in a very large percentage, that we do not have a write-up on is Bitcoin, because it is a macro play. And this is where we think that sophisticated investors, which are the Arca universe, really should have the ability to set their own Bitcoin allocation. And then the real differentiation is how does it fit in their workflows? What's the cost? What are the true hidden costs of these things? Liquidity. And this is our commitment at Arca. And Peter's going to bring you through the properties of our product. We are never going to rush in a product to market just because it's hot or anything like that. And you'll see a lot of asset managers that never thought Bitcoin was, a very good idea, even as little as a year ago, offering you products saying it's the greatest thing since sliced bread. That's not us. But we will always give you the best wrapper, the best way that we think you could get exposure for your workflow. We also encourage holding it directly, but for a lot of institutions that are concerned about custody, how they market, things like that, these are the things that this product addresses. And I'm going to pass it over to Peter here to go through that.
Thanks, Ray. And just to build upon that, very quickly in terms of Bitcoin and why we kind of led with this as the first of our passive vehicles. And Rain is right, in our hedge fund, exposure to Bitcoin is really primarily a way to hedge overall kind of market risk and reduce our downside betas as we manage downside protection across the whole portfolio, as opposed to kind of an underlying expression of value proposition for that particular strategy. That said, it is a extremely large in the asset class and very unique asset. And I do want to address one question that we had live, just because I think it's relevant to what we just talked about before I get into the intricacies of how this particular fund is structured, as well as just remind everyone, if you have questions, there is a Q&A. We will have time for those, and I will certainly try to get to everything. But there was one question that just basically said you seem to be, mixing the kind of distributed ledger technology of blockchain with Bitcoin, and if we could clarify. And yes, those are two extremely different things. And I'm not going to get into like the history of Bitcoin or how it exists or why it exists. But in short, and this is probably redundant for many of you, but what made Bitcoin possible was blockchain as a technology. But blockchain as a technology has many, many, many other applications, and across all aspects, I think, of our global economy. And that is where we seek to invest actively in those applications of blockchain as a technology. And frankly, we use those applications of blockchain as a technology in our Arca Labs business through the ETF structure. Bitcoin is a totally different macro instrument that my personal narrative is, and I think very similar to kind of what Rain alluded to earlier, is it's your store of value. It is your, in essence, Gen Z gold. And I think that is the most simplistic way that to look at it. So if we get into kind of the structure of this fund and why we approached it this way and why we think it's thoughtful. Look, Bitcoin's an asset. Similar to gold, it has a price and it's denominated in dollars, right? And it's inflationary, unlike the U.S. dollar. So it does protect a store of value. And the difference is it's relatively, and especially historically, difficult for individual investors and even institutions to purchase Bitcoin. It is a completely separate infrastructure operationally, right? There are different counterparties. Bitcoin is not a security, so it can't be custodied at broker dealers. If you're a fund, you can't go to your prime broker. If you're an individual, you can't go to Fidelity or Schwab and just buy Bitcoin. You have to have private wallets. You have to take that custody risk yourself. There is no centralized entity or customer service that you can call. If you lose your Bitcoin password, you can't get it back. So there are inherent risks in the overall kind of infrastructure. And for certain people, they have to, philosophically or in practice, they want to hold their own keys. They want to own that Bitcoin. They're big believers in, not your keys, not your Bitcoin. We take a little bit more of a realistic and I think kind of pragmatic stance in that that's just not for everybody. And I think most people probably should not be self-custodying their own Bitcoin. Personally, I don't. It's just not a risk I'm willing to take. From a custody standpoint. I mean, can't tell you how many things I lose in my house, and I'm not willing to lose my private keys. So ultimately, a passive Bitcoin vehicle should do one thing. It should track the price of Bitcoin. And that's a relatively commoditized structure. So when creating a commoditized structure over time, it breeds competition and pricing and fees eventually flow at or near zero. It happens for everything. So our philosophy was, well, let's just offer the best possible terms to investors that we can right off the bat. So we wanted to create a low fee product that offers daily liquidity in and out at NAV. NAV sets based on the actual price of Bitcoin. It's struck at 4 p.m. Eastern every trading day for accredited investors with relatively low minimums, $25,000. As an organization, we're huge believers in customer success, investor relations, supporting our investors and clients, making things as frictionless as possible for them. So that's going to include kind of full onboarding, full customer support, and then getting back to just kind of operational risk. We wanted to work with the best possible counterparties, which we'll get to on the next slide, but that's going to be Fidelity from a custodial standpoint and UMB. So next slide, please. So, here you can see kind of our service providers on the right, from audit to custodians and transfer agents to our custodian, which is Fidelity Digital Assets and legal, of course. In terms of what we're trying to do, again, investment objective, incredibly simple. We want to create something that tracks the price of Bitcoin, where the NAV moves lockstep with the price of Bitcoin, no premiums, no discounts, no lockup. And we are offering this to accredited investors only. We're offering it for $25,000 minimums with daily liquidity in and out of NAV. And we're going to charge 45 basis points management fee, no performance fee, obviously. And then Luca is a service provider, data provider, relatively large and recognized one in this asset class. And that is the third party that is providing, in essence, the price of Bitcoin every day at 4 p.m. Eastern that determines our NAV. Next slide, please. So, there are no shortage of different Bitcoin vehicles that one can invest in if they do not want to take the custodial risk themselves. And, we just put an objective comparison of kind of what those look like, from a management fee standpoint. Now, for Grayscale and Bitwise, those are total expense ratios. They don't actually break out kind of their management fee. And we do have other expenses that will, accrue to the bottom line of investors. However, we do cap that total expense ratio at 1.5%, so in line with the lowest of Bitwise. And as we grow this product, which is very newly launched, there will be operational leverage on that. So it should, it will continue to approach that management fee. There will always be custodial expenses to Fidelity, administrative expenses, but we will certainly get economies of scale on that. You can see the minimum investments. And then I think the big thing really, redemptions, right? Bitcoin is obviously a very volatile asset. It is a store of value, based on its inflationary nature. One could argue whether it will or will not ever actually be a replacement to, say, fiat currencies, but it should be easy to get in and out, and it should be relatively quick to get in and out. So we do offer daily liquidity, as opposed to other vehicles, which is weekly, quarterly, or in the case of some of the OTC providers, not at all, because the liquidity is done through the secondary market. And then, again, Fidelity, we just wanted to work with kind of the what we thought as the kind of blue chip safest custodian, as well as have all of that Bitcoin insured through Fidelity. Next slide, please. So, getting back to kind of just a couple things to think of owning Bitcoin, and do I want to self-custody this versus do I want to custody this institutionally, or essentially have a third-party custody or use a third-party vehicle such as the Arca AI Bitcoin Trust. The pros of self-custody, obviously, the only counterparty you have is yourself, so it does eliminate third-party counterparty risk. Obviously, we've created this product, and I would argue that there's more, I personally have more personal counterparty risk than say Fidelity does. There's always going to be a little more efficiency, speed, transferability, obviously control. If it's my keys, if I own the private wallet, no one can do anything to get that Bitcoin, right? I control it 100%. And that is a positive. And for some people, it's non-negotiable. For others, and for most people, I would say it probably doesn't matter too much. The cons obviously are, again, you are the counterparty, and because Bitcoin is totally decentralized, there is no CEO, there is no customer support, right? There is no organization you can call to say, hey, I can't find my Bitcoin. Like, you lose it, if your computer's hacked, if it's stolen, it's gone, and there's nothing you can do about it. So, I think there's also kind of a misnomer about, again, blockchain versus Bitcoin. Yes, blockchains mathematically, in essence, cannot be hacked. Especially something as kind of long-standing and as large as the Bitcoin blockchain. That is an immutable distributed ledger. However, your Bitcoin can be stolen. Your computer can be hacked. Your password can be stolen. It can be transferred from one wallet to another wallet. You can actually go on to the public the Bitcoin blockchain ledger, and you can see someone steal your Bitcoin, it going from one wallet to another wallet. You can see that happening, and there's nothing you can do about it. And that is just a danger of self-custody. Personally, it scares me, and I think it should scare other people, and I think that's why there are structures like this and some of the others on the previous page. And then look, if you are custodying it yourself, you still have other counterparties, exchanges, wallets, and there are transactional fees that you will pay, and depending on the counterparties you use, those transactional fees can be high. They can be well in excess of the annual management fee that, say, we charge. So I think that's a pretty good overview of kind of pros and cons of self-custody. And in terms of institutional custody, say with Fidelity and through our fund, you buy the fund at NAV, sleep at night. Obviously Bitcoin is a volatile instrument, so there is price risk, of course, but but you eliminate that kind of counterparty custodial risk. You eliminate the worry of someone hacking your own computer, stealing your password, getting into your private wallet, that sort of thing. So you shift that security risk from yourself to an institution. So would Fidelity get hacked? Sure. Unlikely. I mean, they employ some of the world's foremost cybersecurity experts. Not to mention their Bitcoin is insured, but you shift that risk. And the cons, hey, you have counterparty risk. So if you do look at custodying at a third-party custodian, or if you do look at purchasing a vehicle, whether it be us or someone else, just pay attention to your counterparty risk. There's a reason why Arca on the active asset management side has a more extensive operational due diligence process than I've seen throughout my 20+ year career in investment management, because it's a new infrastructure. These are new counterparties, and they require a lot of operational due diligence on which counterparties you can trust and which you should be a little more cautious with. Next slide, please. So Finally, I know there is also, and we've received this kind of question and had this conversation a bunch in the past with investors. Um, you look at something like the Grayscale trust, and I'm not meaning to single them out, but they're obviously in the media a lot lately, and I'm sure most people are familiar with them. So in essence, the way that product works as a OTC traded vehicle is they would offer subscriptions to institutional and accredited investors. I think at a 50 or $25,000 minimum, say, those investors would be locked up, and then the liquidity would be provided OTC. So the reason that you can go onto Fidelity or Schwab or Robinhood or any of these platforms and purchase GBTC is because it trades OTC. So essentially, even though Fidelity Investments or Schwab as a broker dealer can't custody Bitcoin and can't custody a Bitcoin vehicle, these funds are eligible to trade on those platforms because they in essence backdoor access because they're OTC. But what that means is the NAV of the product is solely determined by the supply and demand of the market. So that's why when there was limited competition in terms of other OTC products, other Bitcoin instruments, when Bitcoin was even more difficult to purchase than it is now, and GBTC was the only game in town, you had this inherent ARB, and you had GBTC trading at a massive premium because there was demand to buy it because it was the easiest way. I won't say the only way, but it was the easiest way to access it. And there was very limited supply because even as larger institutions or accredited investors buy directly from Grayscale, they're locked up, initially for 6 months, then later for 3 months. So you create this inherent kind of, I won't say artificial, but it was a supply demand imbalance. Over time, obviously that changed as more competition came to the market. There were other places to invest, internationally, easier to own Bitcoin directly, right? And now it actually trades at a discount to NAV. Now, Grayscale itself does not offer any liquidity, so there's no way to actually realize that ARB and buy it at a discount and say put it back to them at par value. So what you have here in this chart is, your performance of Bitcoin and your performance of purchasing at the exact same time of GBTC. And as you can see, it tracks it in spirit, but especially as that um, premium shifts to a discount, you have a pretty massive dichotomy in terms of performance. And again, doing this solely to kind of educate into the what to pay attention to when you're looking at some of these vehicles. Because ultimately, look, this is a commoditized product. You just want something that is going to track the price of Bitcoin as closely as possible, which is why our NAV is just determined by the price of Bitcoin at 4 p.m. Eastern, kind of every day, as said by Luca. And ours does not trade OTC. So could we raise assets easier if we had that? Maybe. But in our mind, it's not the best structure for our investors. And as Rain mentioned at the very beginning of the call, when we launch a product, we're going to be very thoughtful about that structure, what that product's goal is, what our goal is as an organization, how we are best serving our partners, our investors, and and making sure that in our mind it is institutionally best in class and as best as it possibly can be, um, given whatever limitations exist in the market. We're very proud of this product, very proud of the way it's structured, and think it really gives investors a operationally safe access to a in-demand asset in Bitcoin. So now we'll just kind of get into Q&A, I think. And we had a few before, we picked out a few, and then we have a bunch of questions now coming in live. So please, if you have any questions, feel free to put them into the Q&A, and we'll try to get to everyone. And then of course, should you have any afterwards, please reach out to myself and and we'll get back in touch. So how do I invest in? It's a great question. How do I invest in the Arca AI Bitcoin Trust? What's the process? So it's a Reg D private offering. We have subscription documents and prospectus. We provide those via DocuSign. You execute them. You would go through an AI accreditation check, AML KYC through which is basically proof of identification. That gets sent to UMB. Once that's cleared and UMB receives the information, if it's prior to 10 a.m. And everything checks out, money is wired to UMB, we are able to execute the trade, and we look to do that as close to 4 p.m. Eastern as possible, just so that the print that individual gets is as close to the what we determine to be the NAV of the fund, which is based on that 4 p.m. Eastern price. And UMB Bank as the admin and transfer agent, they are in essence providing you with the information of, okay, so this is the effective price that you purchased Bitcoin at. This is the price. This is the NAV of the fund that you effectively got in at, and you can track that every day. And we do post that on our website. How is the NAV price calculated? I feel like I answered this in the end, but again, not by us, right? So Bitcoin trades very publicly, it trades very liquid. If the third-party data provider, Luca, is used at 4 p.m. Eastern, we get the price from Luca, and that price determines the NAV of our fund. What are the trust security protocols? So I think a lot of this is put onto our counterparties, right? We are, that's why we work with Fidelity. We don't custody the Bitcoin for you, right? We're not doing anything fancy here. This is designed to give everyone exposure, basically dollar for dollar, to the price of Bitcoin. So every dollar is backed 100% by Bitcoin. 100% of that Bitcoin is custodied at Fidelity. 100% of your funds are wired to UMB and custodied there. So, from a security standpoint, we are not taking on that risk. We are not shifting that risk to you. That is why we choose kind of best in breed counterparties. Rain, anything you want to add there before I look through some of the other questions that came in live?
No, I think you really covered it. And I just can't stress enough on things like this, and that people really have to pay attention to in this product, this space, is structure matters. And a lot of the things in this world, because they're so new and there's regulatory reasons around why we do things, and to provide this, that, things that people are not accustomed to, like, like a huge premium that deteriorates, where you can actually have, make your right call in an asset class, try to express that investment view and what you think is a very simple consideration, and then have a completely different investment experience. So liquidity, premiums and discounts, costs, all of those things are incredibly important in this, and that, people are generally not accustomed to dealing with incredibly liquid, efficient markets. So that I just encourage everybody to do the work on how they're doing it. You laid out the pros and cons of self-custody. Think about what you're trying to accomplish. Think about the trade-offs you're making on self-custody, versus counterparty risk, and where you want to fall on that. We are very consultative in our approach. When we don't have a product that addresses an investor need, or even a competitive product that is more appropriate for an investor, we have no problem sending them that way. This is very much, we think, a beginning of this transition to this huge, opportunity here, and it's very much a grow the pie, type of moment. We are trying to welcome as many people in this space as possible and provide the best experience possible, and a lot of that is education, bringing people up to speed, talking about risk, and the incredibly long due diligence processes we are having with sophisticated investors. Think pensions and endowments, who will often have a 36-month like RFP type of process for even a normal asset class. This is all incredibly early, and there's no dumb questions or explaining very much like what your goals are and asking that, and we welcome that. So thanks. I think you really highlighted the important stuff, and great job.
Okay, cool. So let's get to a few more of the questions. So a couple here that are kind of similar in spirit. So we only invest in Bitcoin. Do we have exposure to other digital assets, Ethereum? So Arca certainly has exposure to other digital assets. Our digital assets fund, that's what we do. And we have other kind of actively managed and different vehicles structured differently that invest across the digital assets ecosystem. This particular webinar is solely focused on this product, which is the Arca AI Bitcoin Trust. This is 100% Bitcoin. So this represents a way for investors to get exposure to Bitcoin in a means that tracks Bitcoin, fully from a price standpoint, that is backed dollar for dollar by Bitcoin. And another question we had, and I apologize for this confusion, but basically, so it does not hold Bitcoin, rather it tracks the price. No, we hold Bitcoin. So when we take in, hypothetically, $1 million, we are buying $1 million worth of Bitcoin. And then that Bitcoin is being custodied at Fidelity. So it is a Bitcoin fund. We own the Bitcoin in exact amount with the dollars that we have taken in. And then as Bitcoin appreciates, the NAV of the trust appreciates. So all I meant by tracking Bitcoin is there are Bitcoin vehicles out there, as we've gone over, that do not accurately track the price of Bitcoin. We accurately track the price of Bitcoin because the NAV is solely based, not off market dynamics of buy and sell overs for the trust, but it is solely based on the price of Bitcoin that particular day. So interesting question here. So for those of us already invested in the Arca Digital Assets Fund, thank you for partnering with us. What are additional benefits of investing in this passive trust from an asset diversification point of view? Look, so as Rain mentioned earlier, and as we talked about, Bitcoin is not something that really very well fits the thesis or the goals of what we're doing in the Arca Digital Assets Fund, which I won't really spend a lot of time on this call, but there is kind of fundamental value, long-term holdings of tokens, of companies and protocols that have revenue where we can ascribe economic value to that token. I can't build a model on Bitcoin. I can't tell you what it's worth. Bitcoin doesn't have cash flow. It doesn't really fit that mandate. Not to mention, that's a hedge fund structure fully focused on alpha generation, where you're looking at an index to determine what you're comparing alpha off of, and in that case, the Bloomberg Galaxy Crypto Index, of which Bitcoin is a large percentage of. So it doesn't really make sense for us to invest in a large percentage of Bitcoin and for our clients to pay us, hedge fund fees to own Bitcoin, right? There are much cheaper ways to own and get exposure to Bitcoin, hence this product. So from a diversification standpoint, by owning digital assets fund or investing in digital assets fund, you're not really exposed to Bitcoin. You're exposed to a much longer term, I shouldn't say longer term, you're exposed to a very long-term secular trade around blockchain as a technology and the innovations that can bring to different areas of our economy. With this particular product, you're exposed to Bitcoin, period. That's it, end of story, which is a very good thing in its own right. But you're not exposed to Bitcoin in the DAF, broadly speaking. You are exposed to Bitcoin and only Bitcoin in this fund. And my personal belief, our firm's personal belief, is that both make sense. If you look at a overall kind of allocation to the asset class of digital assets, of which cryptocurrencies is a subset of that asset class, and Bitcoin is a cryptocurrency, then it makes sense to have a Bitcoin exposure as part of that overall allocation, a digital assets fund exposure as part of that overall allocation, should you want to dive further into, venture, NFTs, income related strategies, there's a lot of other things that can be done, and you will see as this space matures. But it is a very different and non-cannibalistic exposure, this fund versus our digital asset fund.
Yeah, and I would just want to add, Peter, and again, the way you see like a hugely variant way that people express something like a gold position from 0 to quite high, depending upon a very personal investment outlook. It's hard to come up with, like a model weighting that we would suggest for something like that. It's very much on, an investor's outlook, their goals, how they view the asset. Some of our investors have a very negative view on Bitcoin, and some of them have a very positive view, and that's fine. But it's very idiosyncratic based on the investor. So that's why we think it's also appropriate for them to set it. And again, try to get it the lowest fee, the most liquid, the best way that fits in your processes possible is the way we look at that.
Perfect. And look, there are also obviously a bunch of questions around ETFs, and obviously, this is in the news a lot in terms of filings, in terms of the recent announcement by Grayscale and potential to convert their vehicle to an ETF, which I think is a way to try to put some faith back in kind of what's going on there overall. And then, do we see, traditional ETF players, right? Your BlackRocks, your State Streets, really entering the space, and how is the SEC evolving, with regards to this asset class and its structure. So, look, we are, I will caveat this by saying no one knows, for certain what will happen. The SEC, I know from a lot of career experience, is extremely kind of patient and diligent in their work, and it does not take approving a new product lightly. And yes, an ETF is not a new product, but it is very different in that Bitcoin is not a security. It can't be custodied at a broker dealer. There are many pricing issues that come into play. It is a totally different operational infrastructure and counterparty infrastructure than the SEC is used to working with. And there are a number of regulatory framework kind of foundational elements that need to be established prior to moving forward on a Bitcoin ETF. So I would encourage everyone to be, kind of a little logical and guarded in terms of when this ultimately does have the opportunity to pass. I know there's a lot of people who think this is a near-term event. I think before we see a Bitcoin ETF, we are going to see Gensler and the SEC move on a regulatory framework for digital assets. AML, KYC, investor protection. How are these assets custodied? How are taxes calculated and tracked, right? There's a lot that has to happen before we just blanket pass an ETF because a bunch of asset managers filed for them. And Arca, having gone through SEC processes with other products, I think we can, be a good kind of level-headed voice on this matter. And you're probably, and this is my opinion, 2 to 3 years away from seeing that. Could we convert to an ETF at some point? Could we launch an ETF? Would an ETF make products like this obsolete? I don't know. I don't know that's really relevant to talk about right now, because even, if and when we're having one, I don't think it's really terribly relevant for the discussion because we're at least 2 years off. And Rain, I mean, the ETF space very, very well from founding Wisdom Tree, co-founding Wisdom Tree. So what What would you add to that? Because there's a lot of questions on this.
Yeah, I would say that regulatory process, especially when you talk about an ETF, which is a 40 Act structure, which the mandate of the SEC for investor protection, and it's the highest threshold of offering, retail investor exposure to this. There, as Peter highlighted, there are very fundamental questions for Bitcoin here that is very different than anything that has ever been put in an ETF or a 40 Act product. The idea of custody. So to take custody as we understand something in the real world is to prove you have ownership. There is no such thing as provable ownership of Bitcoin, full stop. If you have the keys, you control the access to the blockchain, but it is not ownership in the way we think about it in our like centralized central authority world. So there, that's just one example of very fundamental things that have to be solved that the SEC is working through. And I'm very confident that they will get there and come up with a framework, but I completely agree with Peter that it's going to be a framework and they're not rushing to do this. There's not like it took us 2.5 years to get an equity ETF through a wisdom tree through the SEC when we were doing something about combining, holding the index, being the index provider as well as the fund sponsor. So even something that seems as like trivial as that took 2.5 years ago, and there was no impetus to do that. So I think you're going to see a lot of body language of the SEC doing that. You haven't seen it yet. I still think it's rather far off. And as that gets closer, we will always be focused on providing the best structure. So we'll be focused on that too. But we're uniquely situated dealing with the regulator quite regularly on things like Rcoin to have some insight, not directly, but to get a general body language. And we obviously wouldn't file something like this or create something like this if we thought that that was imminent. We're trying to create something that gives the best exposure for the world we live in right now and see how it evolves and work with regulators to bring them along as well.
Perfect. Yeah, thanks, Rain. And look, this is a topic that can merit its own hour-long webinar. So, I'd encourage you to reach out. We can certainly have conversations. I host a podcast for Real Vision called Between Two Chains. I had a former SEC enforcer in the digital asset space who worked under Jay Clayton for 5 years there, solely doing FinCEN enforcement around digital assets. And he had a lot of great things. Ashley Ebersol, he had a lot of great things to say about, the overall environment there and what he thought the timing was potentially of a Bitcoin ETF. Which he mentioned is kind of 3 years, and also expressed recently in a conversation I had with him that he didn't think anything has really changed. So that's a good resource too. But obviously no one knows for sure, but we do need a regulatory framework before we can see something like an ETF. A bunch of other just kind of questions around exchanges we use, where do we buy the Bitcoin from, that sort of thing. So when we receive dollars, and also a question about kind of subscribing. No, we cannot take in-kind subscriptions in Bitcoin in this fund. It has to be USD wired to UMB Bank. So if you do say own Bitcoin in Coinbase and would rather invest in the fund, you would need to sell your Bitcoin, convert, and then wire the funds over to UMB. When we receive the cash, we are executing a trade. We trade for this fund solely through Fidelity. So we purchase the Bitcoin through Fidelity Digital Assets, and it is custodied at Fidelity Digital Assets. So that is the only counterparty exposure we have on this in this structure is Fidelity Digital Assets, which we are extremely comfortable. And then in terms of pricing and how this is priced, what exchange we use. So we don't, and you can see in the slide above, we use the data service Luca Prime. We don't use a single particular exchange to determine the price of Bitcoin. So let's see, bear with me here a second.
Peter, this is a good point for me just to pop in here for a second.
Yeah, please.
Unfortunately, I have another panel that I'm booked right up against this one, so I have to hop over, but I just wanted to thank everybody. I want not to interrupt the flow. Please keep going. And I'll be available for anybody that wants more substantive questions on any of these topics. Everybody on the Arca team is at your disposal. And please carry on, and really thank you for the really thoughtful questions and the chance to engage with you. And I look forward to talking to everybody soon.
Thank you, Rain. And this is being recorded. This recording will be available later as well. A couple other quick questions. What's the difference between this structure and an ETF? Because we do offer daily liquidity, which is obviously at NAV, which is obviously kind of best in class in the market right now. The difference is an ETF is going to have real-time NAV and real-time liquidity on a secondary market. And that is another issue, right? Bitcoin doesn't have a single price, right? It has different prices at different exchanges. So how does the SEC work that out as it pertains to an ETF? How do you handle kind of real-time NAV and volatility, consumer protections, right? So the big difference between this fund and an ETF, you could talk about expense ratios and things like that, but that's not terribly relevant. It's really more about how often is the NAV struck. An ETF is going to have real-time NAVs. We're going to have a daily NAV based on the price of the underlying asset, not based on the market, the market dynamics. And then obviously, the real-time trading nature of an ETF versus ours, which looks more like a mutual fund, where you're subscribing and redeeming daily from the fund at daily NAV. We do have a question about kind of do we require accredited investor through verification, or can we basically, can you attest to it? We do require actual accredited investor verification, and I think that's an important stipulation. Look, one thing we're bringing to this asset class as we really focus on institutionalization of it is full AML KYC, operating as if we are back at kind of a more traditional asset manager, and doing everything kind of in a fully regulated above board way, even if there might be ways to potentially cut corners. It's not something we're going to do. It's just not how we operate. So I know we're pushing up right here at 11 o'clock and our time. So I just wanted to thank you and thank everyone for joining us. Thank you all for your support for Arca. I know there was a lot of questions that I wasn't able to get to. Please, you can reach out at ir@ar.ca. You can reach out to me directly, peter@ar.ca. You can reach out to me at Twitter at PeterDHans82. And thank you everyone for your support, and look forward to hopefully working with all of you soon. Take care.